on impact of direct tax liability, COVID impact on direct tax liability is very, very important, because direct tax reforms are always at the top of the agenda of any government, because taxation system is a system which introduces the welfare in an economy. Firstly, when the spending power of the consumers increases, then the government is also able to spend more. Then that also increases the growth trajectory of the country by so many programs of the government for the welfare inducement in the economy. So I believe reforms are very, very important at this juncture, and government has already introduced so many reforms during the last 2 months to mitigate the daunting impact of COVID-19 on trade and industry. So the objective of today's webinar is also to discuss the reform measures announced by the government and their actual impact on trade and industry, and implications for the stakeholders, from the MSMEs, from the large enterprises, and the wait for stimulus that we have already discussed, that trade and industry is in the very excited zone, that they are seeking stimulus from the government to push the growth trajectory, to push their businesses, and to maintain the employment scenarios in their respective businesses. So I will not take much time, because we have very good experts in today's webinar. So with these words, I would like to request Dr. D.K. Agarwal ji, President PhD Chamber, for his welcome remarks. And before that, I would like to provide a few words about Dr. D.K. Agarwal. Dr. D.K. Agarwal is President of PhD Chamber of Commerce and Industry and Chairman and MD of SMC Investments and Advisors Limited. He is a fellow member of the Institute of Chartered Accountants of India, ICAI, with over 2 decades of experience in the securities market and financial services. His leadership qualities help him manage, control, and supervise a large number of businesses in the capital and commodity market segments. SMC Group is amongst the
right, Sharmaji. I think that's too much talking about me.
2,400 plus spread across 500 plus cities and towns in India. It has 24,000 registered associates, service providers in distribution segment, serving the financial needs of large base of the investors very, very efficiently. So with these words, I would request our President Shri D.K. Agarwal ji to provide his welcome address.
Thank you, Dr. Sharma, for all the nice words you talked about me. Good afternoon, ladies and gentlemen. Mr. Nicholas Jacob, who is an eminent personality, eminent tax lawyer, he'll be joining us soon, and we'll have the opportunity to hear him. We have Mr. Anil Kumar Chopra, our mentor of our Direct Tax Committee, PhD Chamber of Commerce. Mr. Mukul Bagla, Chairman, Direct Tax Committee, PhD Chamber of Commerce. Mr. Rohit Jain, who is partner, Vash Associate, very eminent tax lawyer. Shri Pradeep Mutani, Vice President, PhD Chamber of Commerce. Mr. Saurabh Sanyal, Secretary General, PhD Chamber. Dr. S.P. Sharma, Chief Economist, Principal Director, PhD Chamber of Commerce. Managing Committee members, former President of PhD Chambers, eminent dignitaries, ladies and gentlemen, a very warm welcome to each one of you. We were just talking about COVID-19. You know, it is for last 2 months that India has been facing this COVID-19 pandemic. For us, the month of March is a very significant month, and the outbreak of COVID-19 was witnessed more in the month of March 2020. From book closing perspective, from taxation perspective, and even also from the perspective of doing more business, because a lot of companies, they have their targets and they try to meet those targets by the month of March, 31st March 2020. So I think this was 1 month which otherwise supposed to be a very good month from business perspective, but had been reduced to a month where there was almost very little activity. And once this lockdown was imposed on 24th, though I think on 20th we had a Janta curfew, and then on 24th we had a lockdown, official lockdown being declared by our Prime Minister. So in these last almost close to 2 months, the economy practically came to a grinding halt. There was practically zero activity, zero revenue, zero production, but our expenses continued like anything. So there was cash crunch, there was liquidity issue, and everything came to a halt. Now we have seen that our economy is starting to gradually open. But when you start the stalled activities, it takes time. And again, the activities have been though allowed to be started, but we are seeing there are a number of issues which have come up. Only yesterday there was a directive from the Ministry of Home Affairs that first week of start has to be a trial period. Again, there is an additional cost. Of course, it is needed for the safety of the people. But in terms of business, this is an additional cost. Our economy has been classified, our districts have been classified into red zone, orange zone, and green zone. And activities have been allowed in these zones differently. Not all activities are permitted. It is like they've given the list of permitted activities. It is not the other way around, that these activities are prohibited. So there is a lot of confusion arising from that also. So in a nutshell, during lockdown and even post lockdown, the economic scenario appears to be not very good. During this lockdown, and let us say this lockdown opens on 17th of May. So by that time, we would have lost a huge in the economy. And even after this lockdown opens completely, and let us assume that all the activities are allowed, it will take a lot of time, because this pandemic of COVID-19 is not going to be over. The problem will still continue. This problem will continue till we find a vaccine or till we find some medicine. And till that time, that might take a year, that might take 2 years. Till that time, we have to make this COVID-19 as our way of life. We have to live with this COVID-19. So today, whatever planning we are making, whatever tax, direct tax planning, whatever tax administration is doing, I'm sure that they have to consider all these dynamic environment, how this is going to pan out. The problem is still not over. We have to live with this problem. The normalcy will not return in next few days. It might return maybe after 6 months, maybe after 9 months. So of course, our government has done a lot in terms of giving certain benefits, postponing certain compliances, announcing certain benefits for the poor. But a lot needs to be done in terms of announcing a fiscal package. We are all waiting for that. We were just talking that every day there is a hope that today it will be announced, and then we come to know maybe not today, maybe tomorrow, but that tomorrow is not coming. So let us still hope that it will be announced. Though as PSG Chamber of Commerce, we have talked of a package of 16 lakh crore, which is 7% of GDP. And we strongly believe, as being projected by various organizations who have projected our GDP growth, only yesterday, there was a projection that our economy is going to contract by almost 5%. Even if it doesn't contract by 5%, even if our economy grows by, say, 1 to 2%, as projected by most of the organizations, there is going to be, if that is the kind of growth, there's going to be huge unemployment. There's going to be huge retrenchment. And if that happens, there could be social unrest. The economy can be in real, I'll say, deep in problem. So we at PSD, we thought what needs to be done, what should be our GDP growth to survive the economy and to be on the growth path of 5 to 6% or in minimum 4%. So we came out that there has to be a minimum package of 16 lakh crore. If that happens, then we can grow at a rate of 4 to 5%, which can sustain the unemployment, which can create more jobs, and ultimately we will not have a unemployment problem. So with these backgrounds, now I will come to the today's subject. Of course, the government has done a lot. As I said, they came out with an ordinance, income tax and other contracts, some relaxations being given, which is called Ordinance 2020. So it deferred certain dates of tax payment as well as filing of returns. So the dates of where the payment was to be made between 15 Feb to 30 June, those dates have been postponed to 30 June. And also similarly, the returns for 2018-19 delayed returns, which could be filed up to 31st March, they have been postponed to 30 June. But what I would say, since when this thing was done, after that, we have seen the deferral, we have seen the lockdown 2, lockdown 3. So the lockdown has been extended by another more than 1 month. So one thing that all these dates which have been postponed by the government. So considering that already 1 month more extension has been there of the lockdown, and this 1 month extra lockdown has resulted in even deeper problem for the industry. So we would request our government, our finance ministry, to postpone all the dates of tax payment as well as the filing of returns or for other income tax matters. All those compliance dates be postponed by another 3 months. So similarly, this Vivad se Vishwas Tak scheme was postponed. The last date was postponed from 31st March to 30th June, where you are not deprived of the benefit and no extra 10% is charged. So we would again request that from 30th June, again it is postponed by another 3 months. So that is another thing. Similarly, there had been, interest relaxation which has been done. That instead of paying 18% interest, you would be required to pay 9%. But if we look at the OECD recommendations, the Organization for Economic Development and Cooperation, this organization has made certain recommendations for the tax administrations. And even it has talked about waiving of the interest. So our government, because this postponement, we are not paying the tax liability. We have been given this benefit of postponing the tax liability, say by 3 months, but we are being made to pay 9% interest rate. So we call upon the government to waive this interest. There should be no interest charged. This 9% interest should not be there. And if it is further postponed as we have requested by say up to 30th September, again, there should be no interest charged. So even 9% interest should not be charged, because this is not the time to make money out of interest. We are not paying the interest by choice because we do not have liquidity. This is something which is very unprecedented. So we require this kind of waiver. So that is another thing which our tax committee, our chairman, our mentor to take up with the tax administration, so that this is not there. Similarly, of course, there should be no penalties, which government has also not talked about. So no prosecution, no penalties, and no interest. That is what we should be talking about. Similarly, the withholding tax. Again, there has been deferral, but we would again say that it should be deferred by not by 3 months, by 6 months. Then in other government, in other countries, they allow the deferral of the tax payment. Whatever is your liability, if you talk to the government, if you talk to the tax department, they allow it to be converted as a debt. So similar kind of facility should be allowed in India, where you request the tax administration and then they allow you to pay it by installment. So that payment by installment facility should be allowed even in India. Then tax recovery proceedings, all the tax recovery proceedings which are underway, which are already happening, for at least for 1 year, they should be all stopped, because this is something very unprecedented, and we should request our income tax department, the finance ministry, to stop all tax recovery proceedings at least for 1 year. And the government has done up to 5 lakh rupees. They've said that all tax income tax refunds will be done, but we are saying why up to 5 lakh? whether it is small or big companies, everybody is in dire liquidity stress. So all tax refunds should be made immediately in next 15 days. Then all scrutinies, they should be postponed at least for this next 1 year. There should be no scrutiny. This is what even OECD has recommended, that all tax audit, which we in India, we call it scrutinies, tax scrutiny or risk parameters, they should postpone it for at least 1 year. I mean, the list would be very large, but I would not go deep into that. I would, because we have a galaxy of speakers, we have experts, and we would have the advantage of hearing the one of the world's, I'll say, tax expert, Mr. Nicholas Jacob. So I would not take much time. With this, I close here, welcoming again all the participants. Thank you very much.
Thank you very much, sir, for your very, very vital suggestions for the growth of the economy. And as you rightly said that we can't afford the economic growth size of 2%, because 2% growth rate or even less than 2% growth rate will create a lot of problems in the economy, and employment and other scenarios will be impacted severely. So that should not be the case, that that we grow less than 5% in this economic structure. So with these words, I would request now our chairman Saab, Shri Mukul Baglaji, to provide his remarks, his viewpoint on the same, and now moderate the session going forward. Shri Mukul Baglaji, please.
Thank you so much, Dr. Sharma. My dear friends, I welcome you all to this.
And before that, Mukul Baglaji, please, I would like to introduce Mukul Baglaji.
I think it's not, Sharma, let's not go into that. I think it's fine, everyone.
Sir, I will take few minutes. Mr. Mukul Bagla has an experience of more than 20 years in direct taxation segment in respect of issues related to domestic taxation and international taxation. He's partner at OP Bagla and Company LLP. He is actively involved in PSD Chamber of Commerce and Industry and is the chairman of the Direct Taxes Committee of PSD Chamber, and has organized and participated in various seminars related to various aspects of the Income Tax Act. His area of specialization is cross-border investments and providing consultancy on international joint ventures. Mr. Bagla, please.
Thank you, Dr. Sharma. I thank you all. I thank Dr. D.K. Agarwal Sahab, President of the Chamber, for his excellent welcome address, which had many thought-provoking views. Mr. Agarwal, I think you have extremely expert knowledge on tax and financial matters. Your sessions are more technical sessions than a normal welcome address, which we have always seen in the past. And thank you so much for that, for being here. Coming back to the COVID, I think the impact of COVID on the industry and business has been immense, and the entire industry has been waiting for a stimulus from the government. And we had one press conference by the Honorable Finance Minister on the 24th of March, wherein she gave some concessions on tax filings and payment of taxes. She also gave a lot of relaxation to the government department also for issue of statutory notices and passing of suspend orders. But again, she had another press conference on the 26th of March, wherein she was expected to announce a financial statement, financial stimulus. The capital markets were extremely excited. The Nifty was up by about 400 points. By the time she finished, there was not much as far as the financial stimulus is concerned, and the Nifty had fallen down by then. So the wait for this financial stimulus is still on. Whatever has come, it's probably too little, but we're waiting for more. I'm sure there will be more to come. In today's seminar on the impact of COVID-19 on the direct tax liability, we have a lineup of some excellent speakers. We have our own Mr. Anil Chopra, who is the mentor of our direct tax committee, and he'll be speaking on relief measure expected from the government. And we have Mr. Rohit Jain, who is a partner with Mrs. Vesh Associates. He shall be speaking on other provisions impacting direct tax liability pursuant to COVID-19. We also have a star speaker in Mr. Nicholas Jacob, who's a partner of Foster's LLP UK. who shall be speaking on what is actually happening in UK as far as COVID-19 relief is concerned. In the middle, I shall give a small presentation on the various reliefs and extensions which have been allowed by the government in India for COVID-19. For any question and answers which the delegates may want to ask, there's a web chat available on the Zoom platform. So they can write their questions on there, and at the end of the webinar, we'll try and incorporate their suggestions, their questions. With this, I invite Mr. Anil Chopra for his deliberation. Giving him a small introduction, Mr. Chopra, who's our mentor and has been the chairman of the Direct Tax Committee for the last many years. He's a young warhouse, as he wants to call himself, not a old warhouse as what most people call them. And he's a very senior chartered accountant, managing partner of Dewan P.N. Chopra and Company. He has over 3 decades of experience in tax advice and litigation matters. He has chaired, actively participated, and presented papers in national and international conferences on tax. So over to Mr. Chopra, please. So you have to unmute yourself. Chopra, you need to unmute yourself.
Yes. Thank you, Mukul. D.K. Agarwal ji, President of our chamber. Pradeep Multani ji, Vice President of our chamber. Gopal Jiva Rajkar ji, past President of our chamber. And all the distinguished ladies and gentlemen who are here with us today. Namaskar and a very good afternoon to all of you. The theme in essence of this seminar or webinar is the impact of COVID on tax liability. So what are the reliefs given? This is being dealt with by Mukul. What are some issues which are going to be impacted by COVID? This is being dealt with by Rohit Jain. And what is our wish list? We then also have, as the speakers before me have said, our star speaker, Mr. Nick Jacob. Nick is in the league tables as top 10 private client tax lawyers of the world. He is primarily from London, and we are indeed delighted to have him with us, sharing the UK experience of both relief from hardship as well as stimulus to the economy. India has a close connect with UK, and we thought it would be extremely interesting for us to learn from their experience as to what is it that they are doing and where can we follow the same, where appropriate on our facts. These are challenging times, and webinars really do fill in a lot of space. It is said that when offices and movie halls are closed, the most common sign that movie halls should put up is now running on popular demand at your request, Home Alone. So that name of that famous movie is apt for what we are doing these days. Reliefs already given will be touched by Mukul. I don't want to walk on what he is to discuss. Our president has touched some of them, and steadily they are coming. So the government does realize there is hardship, there is difficulty to comply. Business and offices and teams are closed, people cannot travel, and money is not available. So in all fairness, again and again, time is being allowed to try to mitigate the hardship. So we recently had some relief for non-residents stranded in India so that their forced stay in India should not make them resident. Now, this is for the period up to 31/3/20, but it is now 41 days after that. So something for the current year, which I believe is going to come, would also be required for non-residents stranded in India. This topic of non-residency will further be discussed by Rohit. And there are aspects that though relief has been allowed for individuals, but there are various other factors. What about residency of a company? What is the place of effective management if some people are here perforce? Has the control and management effectively shifted to India? In certain cases, for employees and professionals, if they are non-residents, their income is only taxable in India under the treaty if they are here for a certain period of time. Now, what happens if they are here for forced, for factors beyond their control? So Rohit will touch upon that too. And then what is called business connection or permanent establishment under the treaty? How will such stay in India affect there being permanent establishments in India? And this will also be discussed by Rohit. Relief, as I said, continues. We've just had some clarifications on compliances for re-registration, etc., by charitable trusts. Again, the period has been extended by a few months because it simply was not possible to do it by the original date. Then 8th May, we saw some further. Our president was touching such aspects. CBDT in their central action plan for the first quarter have said that no adverse communication is to be sent to assessees till 30th of June. Now, what is the precise meaning of adverse communication needs clarification. But the concept and principle is there. There is a real intent to mitigate hardship. Our president noted that interest rates have been reduced, not due dates for payments. So when we talk of wish list, it is not only reduction of interest that will matter. The payment dates would need to be also staggered and time would need to be allowed. Again, as far as compliances are concerned, returns, investments, donations, filing of appeals, passing of orders, statutory notices, all this will be discussed by Mukul. But the point that Mr. Agarwal said, there is no change in due date of filing of income tax return, which will go this year. No change in tax audit date. No change in transfer pricing report date or its related return. It is not going to be possible to comply. COVID is not going to go for the next half year or more. So these dates need to be changed now because there is no point of us trying to comply, though all best efforts are going to be made. Continuing with certain aspects that Rohit would be covering, he's in context of COVID. Now, salary is for services rendered. How do you render services in the time of COVID? Now I pay salary and somebody says no services were rendered. Why have you paid? At the same time, they say MCA has given a circular that paying such salary is your moral obligation and it is not a CSR item. Well, if it's not a CSR item, then it is my expense. But these are all interesting aspects. Salary is taxable when due. Due is when services are rendered. TDS is deductible when paid. So I would leave it to Rohit to continue on those aspects, including how our country is going to find ways under mutual agreement as to what is to be taxed where and on what basis. And for residents, for instance, there is an OECD guidance note. Some countries are talking to each other by mutual agreement as to what is to be done. And we'll be very happy to listen to Rohit more on that. Rental income, again, there is COVID. People are not able to realize rent. Rent is what is reasonable rent receivable at fair market. Well, is there really something which is receivable? And when is it receivable? When is it accruing? When is it not accruing? And there is no vacancy, but there is unrealized rent. For unrealized rent, there are rules. Those rules have artificial restrictions. So will I get the deduction? Won't I get the deduction? Of course, there are provisions that if I subsequently receive, it is taxable. And then there is interest, pre-construction. What happens if there's delay in construction? There is taxability of stock in trade for a business, for notional value, not for real income. And the exemption is for 2 years from completion certificate year. Now, what happens if all these periods are going to be perforce in the real world, commercially extended? Because people are not going to be able to perform. Rohit will also talk about capital gains and income from other sources under deeming provisions. These deeming provisions are such as taking capital gain consideration at stamp duty value under section 50C or 43CA, or taking inadequate consideration to be income as income from other sources, again at stamp duty value. We all know that there are numerous cases when the stamp duty fair value simply is not the real value. It wasn't before, and after COVID, there is no buyer perhaps. So it is even less so. So these provisions would need to be modified in the reality to tax real income and to avoid litigation, to avoid hardship. Our Supreme Court has said repeatedly, tax real income. Do not tax hypothetical notional income. See things from the eyes of the businessman and the assessee. See things from the real commercial sense. And once again, these aspects need to be addressed, and addressed very quickly. As it is, there is hardship. Nobody can afford litigation on today's date. I may pause. I see Mr. Nick Jacob there. Welcome, Nick. It's very good to have you with us. We then come to our wish list. There are two main points which the leadership of our chamber talks about: to relieve hardship and for stimulus. One is liquidity, one is creation of demand. So even when we talk about our wish list for tax, along with the points that we have been mentioning so far, the hardship removal, the stimulus has to look at creating liquidity, has to look at creating demand. Now, when the president said, please give time for payment, please do not charge interest, at least not for a certain time, give time for payment of withholding tax, then he's talking about creating liquidity. Business has lost too much, and small, medium particularly simply do not have the money to comply. And then what is there to comply in withholding tax, for instance? If A is going to have a big loss this year, then why should somebody making payments to him deduct tax at source the way he normally will? And if the only way out is that he goes and gets a certificate from the assessing officer, well, that is again not ease of business. That is not efficient. And it will take so much of loss of resource to try and do that. So why not just modify? Let's take those sectors which are most hit and give time as far as such compliances are concerned, such as tax. Give relief from interest. Let there be some moratoriums. And if there is tax at source for particularly hit sectors, then if nothing else, let's halve it. If tax was to be deducted at 10%, it is our feedback that most of these houses are not going to have income this year. Please halve it and make it 5%. Because first there is deduction, he as it is does not money, and it will be a long time before he gets his refund back. This issue of refunds, 5 lakhs, the board has said, and much has been done. Our request is there is as much as a need for higher sums. Let there be some time limit and some accountability of the officers. Let the government monitor this, please. If the refunds are not given in reasonable time, then there should be accountability for the same. Equalization levy, new levy of 2%, e-commerce. We are increasingly seeing the importance of e-commerce. In fact, there are new models of business operating. I heard that now business will be done sometimes by the Kirana store in the local area, collecting orders, and he in turn takes delivery from the e-commerce operator and provides the goods to his customers. If that is the importance of e-commerce, along with there being the perhaps amongst the few who had the logistics and the scale and the model to deliver services and goods in these extremely difficult times, then this may be the time to encourage them rather than put additional levies, because in any case they work on such fine margins. We need to remove this levy, and if not, then we need to postpone it at least to the next year, please. Tax collected at source in certain cases on sale of goods. Here again, I would please request, there are difficulties, there are low margins, there are losses, and we want to be competitive in the world. We need to be India the preferred destination. We want to promote Make in India. That these are not ease of business. That tax collection at source on sale of goods. So please take this away. If not, please defer it for 1 year. Health-related scientific research. For instance, if a company is doing research on COVID, then please continue with the weighted deduction, which was there earlier and is not going to be there from this year. In fact, there is even more need for that to be there this year. Use of CSR funds for COVID. This has been allowed. I would go a step further. Let such user of funds be a permissible expense. Charitable trusts, they have their own income and accumulated income, sometimes for specific objectives. Please allow charitable trusts to use their accumulated funds as a tax reduction, regardless of their original objective of accumulation. There is no better cause than relief from COVID at the moment. Healthcare, huge need of the moment. And it is very interesting. On the one hand, we salute the health workers and we all appreciate them. On the other hand, a lot of medical facilities are lying part used because people are afraid to go to hospital for normal matters. They need to ramp up. They need to get better equipped. They are the ones in the front lines. I request that health sector, we need to create health infrastructure in our country. Please give them 4 years tax moratorium, rather tax holiday for 4 years. No tax health sector. 4 years. Carry back of loss. Now a company may have paid 100 crores of tax in the last 3 years. Factors beyond its control, act of God, this year it has a loss. Please permit them to carry back the loss. Let it be for 3 years, and if not 3 years, at least to last year. Let me at least adjust if I am a company involved in such activities. my loss of this year against the income of last year. And if there is an amount coming back to me, let that be refunded to me expeditiously, please. Increase depreciation on commercial buildings. Real estate sector suffering. There is too much difficulty there. We need to incentivize them. Mark-to-market losses. Our president is very familiar with the stock exchange and what is happening in the market. And so is our vice president. Now, let mark-to-market losses be allowed. They have not been allowed despite accounting principles. Let section 40 capital A subsection 13 be removed. Healthcare services and workers, I repeat, all of us have the highest regard for them. We saw the armed forces showering petals on medical facilities and more. 30% tax reduction to all healthcare workers is my request. So tax deferment, liquidity, demand. The tax deferment will create the demand. And if the government needs money, amongst other things, let there be a special bond which is created, give a tax reduction for it, call it COVID bonds, and give the cessi a substantial deduction the way it is given in ATC. Let there be a separate section. The government can take in a huge sum of money for such bonds. We will listen to Nick on the UK experience, and whatever we are trying to seek is based on a simulation of what is happening in several other countries. But in brief, what is it that some of the other countries are doing? Deferral of tax payment, accelerated depreciation, moratorium on tax payment, quick refunds, carry back of loss, lower installments of tax. So first half year, don't expect advance tax, please, from assessees. Up to September, how many assessees will have income? So do not charge them even 234C interest for short installment. Corporate tax rate reduction. I'm not asking for this because the government has very kindly rationalized our tax rates. But we are seeking time and moratorium. Rebates, carry back of loss, special reliefs for specially hit sectors. We are seeking the same. Employment support and health system support. We are seeking the same. Only if industry survives and thrives will employment also survive and thrive. We all wish to maximize employment in our country. We have an obligation. We wish to do what we can. But we need the support of the government also for this. I do not want to go too much into UK, except just touch in concept as to what they have done, because we have Nick here, especially with us. Tax deferment, salary support, government guarantees for finance, loan schemes, bounce back loan schemes, etc. Details follow. I wish you all a rewarding and interesting afternoon. Thank you very much for being with us. Mukul, back with you, please.
Thank you, Anilji. Indeed, an extremely thought-provoking session, especially your inputs on the carry back of loss. It's a new concept. Let's hope that, but a very important aspect, because even if you have made profits till March, but you've made huge losses in the coming months. So that's again a very, very important concept. Even the points on equalization levy and the TCS on sale of goods, very important, sir. Let's see what all government can do. We have already given our representation, so let's see what all can be incorporated. With this, I would start my presentation on various various concessions or reliefs which the government has already given. As I already told, there's not much, but I'll just start with my presentation on that. Starting with my first slide, it is something which has been covered by my predecessors on this webinar. What I need to emphasize on is that regarding the interest being charged on the late payment of advance tax and the self-assessment tax, etc. What I need to ask is it was not even possible to pay the tax or the advance tax when the lockdown happened. So how can the SSC be penalized for that? That is one aspect. And as we have seen in many developed countries like USA and UK, they've already deferred payment of tax. So when they've actually deferred the due date of payment of tax, the question of charging of interest does not arise. Next, the rate of interest at 9%, I would say is very high. Even if they wanted some taxes to be collected, they could have a very nominal rate of say 3 to 4%, but 9% is a very high rate. As Mr. Chopra was discussing about the advance tax payments, which is due on 15th of June for assessment year 21-22, when we have no idea what the position of profit is going to be in financial year 2021, I don't think we are in a position to compute our tax liability and pay advance tax. So in case we don't pay the advance tax, we still will be liable to pay interest, which I think is not a very good scenario. Secondly, as far as the charging of interest is concerned, when we say that the rate of interest is going to be 9%, it's not going to be 9%, it's going to be much more, because the interest what the government charges is not for 1 month. So even if you have a 15 days delay, you would actually end up paying interest for around 2 months. So effective rate of interest in these cases on late payment of TDS sometimes works out to as much as 18%. We briefly touched upon the extension of due dates for filing of the returns of income. My very important point, all the income tax returns which were due on 31st March 2020 for assessment year 1920, whether they were the belated returns or they were the revised returns, the government has allowed an additional time of 3 months. That is, it can be done by 30th of June. The due date of filing of TDS returns, again, they've extended from 31st May to 30th June, which again is a very welcome move. The due date of filing of returns for specified financial transactions has been extended from 31st May to 30th June. So these are all welcome steps. One very important point which needs to be noted is in respect of the due date for the Vivad se Vishwas Act, which was meant to reduce a lot of litigation. So as of now, what has been told by the government department is that the due date, even if the SSC makes payment of tax by 30th of June, the amount of tax is 100% of the disputed tax. So they have not given any clarity on what is going to happen if the tax is paid after 30th June, or whether whether the scheme is closing on 30th June. So in the current scenario, when there's a total lockdown, I don't see any scenario wherein people would be able to make applications by 30th June, and then these applications need to be cleared by the income tax department by 30th June. And then in some cases wherein orders under section 154 have to be passed, for them to be passed by 30th June, and then SSC pays the tax also, keeping in mind the adverse liquidity condition. So I don't think that the date of 30th June for all these Vivad se Vishwas cases is practical. I think we definitely need an extension on that. Coming back to the next point about the time limit for making investments for claiming benefit under Chapter 6A, I think it's a very, very welcome step. Any payments of life insurance premium or any PPF, etc., to be deposited now can be done by 30th June 2020, even in respect of income tax returns to be filed for assessment year 2021. One more point which the government has extension has been given is in respect of donation to PM CARES Fund. So deduction at the rate of 100% shall be allowed for assessment at 2021, even if the payment of donation is made by 30th of June. There's few steps which have been taken in respect of due date, extension of due date for linking of Aadhaar with the PAN from 31st March to 30th June. There is extension in due date for filing of appeals before the CIT appeal. All due dates which were falling between 20th March to 29th June have the due date of compliance is 30th June 2020, which, as we have been discussing earlier, also seems a little unpractical, because I don't know when the lockdown is actually going to open up and when the actual working will start in all these matters. The Honorable Supreme Court has extended the due date for filing appeal before the Supreme Court, with all appeals which are to be filed between 20th March to 29th June. It has been extended till indefinitely till further orders, which is a very welcome move. What has also happened is, like, the department has given some concession to the assessee, but at the same time has also given extension to its own employees. So a lot of matters wherein the notices had to be issued by 31st March 2020, the employees, the income tax department gets a lot more time now. It has much more time to do a lot more inquiries till 30th June, before which they can issue the notices under section 148 or notice under other sections, whether it is scrutiny or whether it is 153A in case of such matters. The government has also extended the time limit for issuance of orders under section 143(1) and other time barring matters. So all orders which had to be issued between 20th March 20 till 29th June have now been extended to 30th of June. Now we have been, our president has discussed this point in detail, and Mr. Chopra has also discussed this matter. I'll briefly touch upon one thing, that in this last year for assessment year 17-18, the due date of filing of completion of assessments, the income tax assessment under section 143(3) was 31st of December 2019. And this period of passing the order was reduced by 3 months for this year. So all the scrutiny assessments had to be done by 30th September. Our president said that all these matters shall be suspended, or the scrutinies shall be suspended. I don't know whether legally how much of that is possible, as the statutory notices have already been issued. But one thing is certain, that there's no way that 30th September, that these time barring assessments can be done by 30th September. One more aspect which I would like to discuss is that, yes, on Friday there was one notification which came that there'll be no scrutiny notices for the last, for the next 3 months, that is from the period from April till June. But I was surprised to see one notice in my inbox today in the morning. So that was a little surprising, but I am sure that till 30th June, there may not be any further notices, but completing the assessments by 30th September is absolutely not practical. We have some due dates of filing of ITRs, which Mr. Chopra had also discussed, that all these due dates have to be taken care of. We simply cannot we're not geared up to file returns by July or September for individual and corporate SSCs. The next slide is about, this is actually a good step that the government has given. A lot of hardship has been saved from many SSCs who apply for deduction of tax at a lower rate as against the rates which have been prescribed in the Income Tax Act. So there are 2-3 conditions for this. So I'm just trying to explain a few of them in a quick time. Cases where the assessee has already filed the application under Section 197 for financial year 2021. So if such assessees were issued 197 certificates in financial year 1920, such certificate shall be valid till 30th June. So this is extremely welcome. So even if you have applied, but the certificate has not been issued under Section 197, then the old certificate which was valid till 31st March will still be applicable for another 3 months. In case of assessees who could not file the application, but were issued certificates in last year, then their old certificates shall be valid till 30th June. But these people would be required to apply to the AO as soon as normalcy is restored, or before 30th June, whichever is earlier. In cases where the assessees were not issued certificates in the last year, and in cases where the assessee has not applied also in this year, that is for financial year 2021, the government has notified a much simpler procedure for the application, and the assessee needs to apply online for that. Very important clarification which the CBDT has given on 9th of April in respect of such certificates, that where the certificates have been issued in financial year 1920 and the threshold limit per assessee, the transaction limit per deductor has been specified, then the same limits would be applicable for this 3 months also, for the period 1st April to 30th June. The only issue which is that how this 197 certificate, which was issued for financial year 2019-2020, shall be integrated in the system for financial year 2021. Because as we know that the income tax liability of the TDS return of the deductor is filed based on this 197 certificate. So if a certificate has been issued for financial year 1920, how the system, the income tax department system, will integrate it for financial year 2021, that remains to be seen. I hope no income tax demands are raised on this account. A few other important announcements or concessions which the government has announced over the last 1.5 months. One of them is that where the payment of donation to the PM Cares Fund on behalf of the employee has been paid by the employer. In such cases, the PM Cares Fund will issue a consolidated donation receipt in favor of the employer. But the employer, by way of the Form 16 or the salary certificate, will give this benefit to the employee, and the employee can take the benefit in his income tax return. The issue of refunds has been touched upon by Mr. Chopra as well, wherein a press release was issued on 9th April, wherein it was mentioned that all pending refunds up to ₹5 lakhs need to be issued. Government has mentioned that they have issued about 10.2 lakh refunds for a total amount of ₹4.50 crores. So I don't know whether it's a very high figure. In fact, as per the direct tax figures which have come for April 2020, the direct tax collections have actually increased by 36.5% to about 35,000 crores. So increase of direct tax collections in the month of April 20 is on account of 63% fall in the amount of refunds issued. So that actually means that the refunds which have been issued this year are 63% lower than what were issued in last year. So most of the people who are expecting refunds are those who are having some financial troubles, and I would feel that it's an apt opportunity for the government to issue these refunds as early as possible. This issue of refunds is not a part of the financial stimulus. It is actually the taxpayers' own money, which has been paid in excess by him and for which a refund is being claimed. So it is not a part of the financial stimulus. It is the money belonging to the assessee, which needs to be refunded. The government may not have funds to make these refunds, but as we all know, these refunds carry an interest rate of 6%, and the bank can borrow. The repo rate is 4.5%. The reverse repo rate is 3.75%. The government is issuing bonds, fresh bonds at 7.75%. So they can always borrow and at 6% and settle the liability of the taxpayer at 6%. So I would say that the government really needs to make a lot of effort of settlement of these refunds. We've already touched upon the circular dated 8th May 2020, wherein the Honorable Finance Minister ordered the Income Tax Department to make an exception for non-resident Indians who are stuck in India due to coronavirus. So they have clarified that the forced period of stay will not be counted in their while deciding their residential status. Regarding registration under Section 12A, which was introduced by this year's budget, wherein all charitable trusts have to re-register themselves. The time limit for applying was 1st of August, which has now been extended till 31st of December. So that's a welcome move. A slight boon in today's scenario, the increased use of technology. We are seeing that a lot of in the Honorable ITAT in Delhi has shifted to final hearing of appeals through video conferencing, saving a lot of time of tax litigators like us, which is a very, very welcome move. We have some positive side to the immensely sad COVID-19 situation. We have, on a flip side, we may not have any searches, we'll not have any surveys, hopefully no recoveries, hopefully no scrutiny notices, less compliances. With that, I think I've covered most of the reliefs which have been announced by the government. I conclude my presentation on the same. I hope and pray that the financial stimulus, including the tax concessions and other benefits to save the business and the industry, is announced soon. With this, I would hand it over back to Rohit Jain for his presentation, giving us short I just need to close my slide 1 second, please. Yeah, thank you. So giving a brief introduction to Mr. Rohit Jain, partner of Vesh Associates. Rohit is a lawyer by profession, a regular guest and speaker at the PhD chamber, always forthcoming with his enlightening thoughts. Senior member of the tax group in New Delhi and has been associated with the firm Vesh Associates since 2001, sorry. His practice covers all areas of direct tax and allied laws, including income tax and Benami law. So over to Rohit now.
Yeah, thank you, Mukul. Very good afternoon to everyone. First of all, let me thank PhD for giving me this opportunity to be part of this webinar on impact of COVID on taxation. We all know that this is an extraordinary situation which we are all facing, and any extraordinary situation requires extraordinary solutions. What is important is to make appropriate representations to the government, to the relevant authorities for various relaxations. And in fact, the government of the day has been very positive. They have come out with very proactive, they are being very proactive in coming out with resolution, with various circulars and relaxations. And the recent circular of on the involuntary stay being excluded for the purpose of computing the residential status is actually in that direction only. Therefore, it is very important to make representations and point out what is going to be the impact of COVID 2019 under various tax provisions. With this, I think I'll start with the slides. This just to highlight the economic challenges which are being faced today by the country. While we all know that there has been all-round shutdown of the economy, there are huge losses being suffered by various sectors. Some of the most adversely affected sectors are aviation, auto, tourism, etc. And that is why I think my earlier panelists have highlighted the fact that there is a increased need of stimulus which the industry requires. And unless that stimulus package comes, it will be difficult and there will be huge loss of employment. So therefore, everyone is actually looking forward to that stimulus package, which is expected to be announced by the government in this week. Now, these are the three items which I am broadly going to discuss is the impact of COVID on residential status, the taxation of notional income, and the recognition of losses. Coming to the first important issue of residential status, in fact, this would have been a big issue had the CBDT not come out with this circular recently on 8th May itself. Now, before I come to the circular, the specific items which have been pointed out in the circular, we all know that the residential status is one of the important aspects of taxation under the Income Tax Act. It has both long-term as well as short-term implications. The short-term implications being the scope of taxable income for the relevant year for which the residential status is being determined, and the long-term implication being the residential status of even the subsequent years being affected if the residential status changes. So, for example, for an RNR category to be maintained, 9 out of 10 previous assessment years are seen. So, if the residential status of a person changes in a particular year, then that may impact his residential status in the subsequent year. So therefore, I said that it has both short-term as well as long-term implications. And once you become resident in India, then the entire global income becomes taxable, and then one has to go to treaty provisions, Tribeca rules, etc., etc. The residential status under the IT Act, as we all know, is determined on the basis of period of stay in India. The threshold being 60 days or 182 days. Depending upon the number of days stay in India, your residential status is determined. Now, in this background, an issue which was bothering all the tax professionals and the taxpayers was whether this period of forced stay in India, when the people are actually stranded in India because of a complete lockdown, the flight restrictions, the airports being closed, whether this period of involuntary stay is to be considered or not to be considered. Now, this judgment of Suresh Nanda, if I just briefly touch upon this judgment, because the circular as it stands today is applicable only for financial year 2019-20, and this has been issued only to be applicable to individuals. So there will be impact on the residential status of offshore entities, which I will be touching upon in a little while. And therefore, this judgment of Suresh Nanda, despite the circular, may be relevant to some extent. Now, what happened in this case was the facts were a little peculiar. The taxpayer had come to India for some purpose, and after visiting India, his passport was impounded. After a long battle, the passport was found to be illegally impounded, and pursuant to the directions of the Supreme Court, the passport was released. In the meanwhile, because of the passport being impounded, the taxpayer was unable to travel outside, but travel from India in order to maintain his non-residential status. His case before the tax authorities was that for last more than a decade, in fact, from some 85, 86 or somewhere, he has been a non-resident in India, and therefore he repeatedly prayed before the authorities that he may be allowed to leave India in order to maintain his non-residential status. In this background fact, the tribunal came to a finding of fact in the case of that taxpayer that since the passport was wrongly impounded by the authorities, since the assessee was forced to stay in India, even though he wanted to leave in the country in order to maintain his non-residential status, in such circumstances, the period of involuntary stay in India cannot be considered for determining the residential status of the assessee. The judgment of the tribunal was affirmed by the Honorable Delhi High Court. And according to me, this paragraph actually gives out the ratio of the judgment of the Delhi High Court And I'll read some of the observations. The presence in India against the will or without the consent of the citizen not ordinarily be counted adverse to his chosen choice, particularly if it is brought about under compulsion. Yeah, particularly under compulsion, or to put it simply, involuntary. There has to be, in the opinion of this court, something to show that an individual intended or had the animus of residing in India for the minimum prescribed duration. So, what basically the judgment or the ratio of this the judgment of the Delhi High Court is that if an assessee is forced to stay in India, despite and it's an involuntary stay, and if on facts it can be proved that it's an involuntary stay, then in that situation, merely because the law says that your physical presence in India has to be the basis for determining your residential status, the period of involuntary stay ought to be excluded. But what is also is important is to take note of this caveat which was added by the Delhi High Court. And I'll read a few lines. They say that view taken by us in the case of the assessee here is in the peculiar facts and circumstances wherein he was inhibited from traveling out of India on account of such action of law enforcement agencies as was found to be wholly unjustified. Here it is important to notice that the passport impounding order was invalidated as without authority of law. The finding on whether in a given case an assessee's claim to extended stay being involuntary has to be fact dependent. Of course, the Delhi High Court said that it is a fact dependent issue as to whether or not the period of involuntary stay has to be excluded or not. Uh, but now, if we were to apply this judgment to the fact to the prevalent facts, which is a COVID 2019 situation where airports are closed, flights are not moving, no one can move out of the country. In that situation, according to me, if on facts one would have demonstrated that yes, his stay in India was involuntary, he actually wanted to move out of India in order to maintain his non-residential status. In that situation, one would have applied this judgment to say that his involuntary stay in India should not be counted. Now, what is also important to see that before India came out with the guidelines, there are already guidelines being issued by various countries. UK being the first which has come out with the guidelines, and I am sure Nicholas is going to deal with it in little detail. Then Australia has come out with guidelines. Ireland, there are guidelines being issued to provide for force major circumstances to be excluded. And US laws also has the guidelines for exclusion of this period of this stay. Now, coming to the CBDT circular, this is a very welcome circular which has come, which has been issued on 8th May 2020. In fact, after I had prepared my presentation, this circular came, and then I had to amend this presentation to include this. Basically, what the circular says is that it is applicable for financial year 1920. The period of involuntary stay from 22nd March 2020 to 31st March 2020 shall not be considered for the purpose of determining the residential status. And what is also important to note is the press release dated 9th May 2020 issued by the government clearly says that similar relaxations are likely to be announced for the financial year 2020-21. Those would be interesting because for this financial year 1920, the period of involuntary stay, if at all, was very limited. That is from 22nd March to 31st March 2020. What will be important to see what kind of period is excluded for the financial year 2020-21. As I said, that this circular which has come is actually applicable only to individuals. Now, insofar as the COVID 2019 involuntary stay will also has an impact on the residential status of offshore entities. Now, offshore entities, if we see, the taxation is based on the twin principle. One is the principle of determination of permanent establishment, which is as per the treaty. And secondly, under the act, which is based on the POEM, whether the company has a POEM in India or not. Now, insofar as the treaty part is concerned, of course, there are no specific guidelines as to whether the COVID 2019 will have an impact on the existence or non-existence of a treaty at a place different from the normal permanent establishment. But OECD has come out with the guidelines, with the guidance dated 3rd April 2020, which is called as OECD Secretariat Analysis of Tax Treaties and Impact of COVID 2019, wherein they have elaborately analyzed various PE issues. And the broad theme of that guidance which has been issued is that the temporary and non-permanent location of any employee should not have any major impact on the determination of a PE of an offshore entity. So basically what they have said is that just because an employee may be working from his home for a temporary period due to this extraordinary circumstances, just that will not be considered for the purpose of determination of the PE of the offshore entity. What is however important to note is that this is only for a guidance. This is a not binding kind of an advisory, and therefore it will be important if some kind of a formal kind of a guidance is issued by the government. Now, insofar as non-treaty is concerned, when we come to the determination of the residential status of an offshore entity under the Income Tax Act, we have to see whether the POEM, which is we called as place of effective management of the company, is in India or not. Now, in order to determine the place of effective management, the board has come out with a very detailed circular in 2017, which has fundamentally two criteria. The one criteria is dependent upon, and the two criteria are dependent upon A, whether the company has an active business outside India, or the company does not have an active business outside India. In case of a company having an active business outside India, the POEM is determined by the majority of the board meetings. So if the board meetings are taking place outside India, then in that situation, the POEM will be outside India. However, in case of companies who do not have an active business outside India, the POEM is determined basically on the basis of the location of the key decisions being taken by the key personnel. Now, this aspect, according to me, may have some impact because the key personnel may have been stranded, just like individuals. The key personnel of the offshore entities may have been stranded in India. This being an extraordinary situation, you cannot defer the key decisions to be taken, so they may be forced to take key decisions from India. Now, to what extent the location of those key persons in India and they're taking decisions from India will have an impact on POEM will again be a matter of dispute and litigation. There have been representations being made to the government that while you have come out with a circular on individuals, a similar kind of circular should also be come out with entities. As of now, the view of the department appears to be that there is no circular which is required in case of entities, and and probably the view is that in case of entities, if the POEM is in India, then they should go by the if the benefit under the treaty is not available, then they should be required to pay taxes in India. That would, according to me, only lead to complications, or that will only lead to litigation. And the proper course would be to come out with some clarification or some advisory in order to avoid litigation on this aspect. Now, the second issue which I wanted to discuss is the impact of COVID on salary. It's a very known fact, and it's prevalent in almost every industry and in fact every organization today, that the first impact of COVID 2019 has been on the salary structure. There have been three types of impact. One, either the reduction of salary. Second, there has been realignment of salary. So, for example, where people are getting fixed and variable components. So the fixed component has been reduced. The variable component may have been increased or may not have been increased. And the third is deferment of payment of salary. Now, we all know that the taxation of salary is based on the due principle. The due principle means if the salary is due, then in that situation it is taxable in the hands of the employee, irrespective of the fact whether the employee actually receives the salary or not. But at the same time, what is important to note is that the withholding obligation on the employer under section 192 is on payment basis. So there is a dichotomy. While the employer may not have deducted TDS and obviously he will not deduct it if he has not made the payment. But employee may still be taxable on due basis. Now the issue that would arise, whether in case of reductions of salary or realignments of salary, whether that salary would still be taxable in the hands of the employee. According to me, that's my personal view. According to me, if there is a reduction of salary or realignment of salary, that cannot, on a notional basis, be subjected to tax in the hands of the individuals. And the reason for this is this: the employment is basically on the basis of an employment contract. The contract has two sides. The employee is required to to render services, and the employer is supposed to pay the payment of the remuneration. And now the COVID 2019 has actually created an impossibility, both at the end of the employer as well as the employee. At the end of the employer, in the sense that the workplace cannot be opened due to restrictions, and at the end of the employee, because the employee cannot travel to its workplace in order to render the service. In that situation, if there is a reduction of salary because the time spent or the services rendered is not as what was agreed upon in terms of the employment contract, then if there is a reduction of salary, there appears to be no justifiable reason to hold that the original amount as mentioned in the employment contract should still be regarded as the salary due to the employer, to the employee, and therefore cannot be subjected to tax. So in the first two situations where there is a reduction of salary or realignment of fixed and variable components, according to me, what salary is actually received can only be subjected to tax. But in the third case, where there is actually only a deferment of payment, where without any reduction of salary, in that situation, there may be some issues at the on the taxability in the hands of the employee, in as much as on due basis, the income may be taxed in the hands of the employee, despite the fact that the employee may not have received that salary. To support the non-taxation of the salary on a notional basis, these three judgments are quite important. One is the Elwood W. Russell, which says that the due does means not only the obligation on the part of the employer to pay and the right of the employee to claim the amount. So once there is a reduction, and importantly, the employment contract is a bilateral contract. It's a contract between an employer and the employee. So it is open to the parties to change the contract. So if with the consent of the parties, there is a change in the terms of the contract and there is a reduction in the salary component. In that situation, one cannot say that the employee still has the right to recover the original amount, and therefore, on a notional basis, the amount cannot be subjected to tax. And again, there is a principle of taxation of real income, which was also highlighted by Anil Chopra sir, that under the tax, what is actually taxable is income. And when we talk of income, and the concept of accrual comes later. So when we talk of income, the income means the real income and not any hypothetical or notional income. So therefore, the salary which is actually not received cannot be subjected to tax. And coming to the next item, which is the rental income, we all know that the rentals, there have been pressures on the rentals being received. Most of the tenants are actually trying to invoke the force majeure clause, whether or not, I'm not going into the issue whether that clause can be rightly or not right, can be rightly invoked or not. But the clause is being invoked to justify non-payment of the rentals. Now the issue which arises is whether a notional rent can be subjected to tax in the hands of the landlord. If we see the taxation of the rental income, it is governed by section 22 and 23, which talks of the reasonable rent. And when it talks of reasonable rent, while the vacancy is covered, the period of vacancy is specifically excluded from the taxation of rentals. But specifically the unrealized portion of rent, when the tenant is actually sitting in the premises but not paying the rent, is not specifically covered in the section 22 and 23. So what happens, whether I am subjected to tax on the unrealized rent? According to me, the one can take shelter from section 25A of the Income Tax Act, which talks of taxation of unrealized rent. Actually, this section 25A, if we see, is a section to tax unrealized rent. So it's the other way around, to tax an unrealized rent in a situation if it is received subsequently. Now, relying upon this section, one can reasonably argue, though it's litigative, one can reasonably. Hello?
Darling, thank you.
One can reasonably argue that unrealized rent should not be subjected to tax, and what should be subjected to tax is only the actual rent. Then the other issues which are going to arise is with regard to the deduction under section 24. Now, 24 provides for deduction of interest on borrowed capital for the purpose of purchase or construction of the house property. Now, the deduction is subject to the condition that the construction should be completed within 5 years. Now, due to COVID, there are going to be delays in completion of construction. One may not, these 5 years mandate may be breached in some cases. In that situation, to what extent it would be justified to deny deduction under section 24 is an area which needs to be debated. According to me,
Rohit, you need to conclude in 5 minutes, please. Because
okay, I'll just do that.
Thank you.
So basically, it is important to, I think, relax this condition to a little bit. At least this 1 year of COVID 2019 should be directed to be excluded by way of a relaxation. And this real estate industry, this stock in trade, rentals of stock in trade, again is a matter, because there again, for 2 years, the notional rentals are not subjected to tax. I think this also needs to be similarly relaxed. Moving on, I think the last issue which I just wanted to discuss, which is an important issue, is taxation of capital gains on other sources. As we all know, the best way to, whenever there is a liquidity crisis, the best way the people prefer is to liquidate by selling the surplus assets. In that situation, in case of usually the people resort to selling of plant and the surplus land and building. The land and building is subjected to tax under section 50C in the hands of the seller and 56 to 10 in the hands of the buyer. Now, again, this is based on the stamp duty valuations. And as Mr. Chopra also pointed out, stamp duties today are actually at a very high rate, and which may not be commensurate with the actual fair value of the property. In that situation, there is an exposure of notional income based on the difference between the actual consideration realized and the stamp value to be taxed both in the hands of the seller as well as in the hands of the buyer. Now, there is a safe harbor of -5%, which is contained in the relevant provisions. I think this is unrealistically low, and this one would expect the government to increase this safe harbor of -5%, at least to 25 to 30%, particularly in light of the COVID crisis. And the last issue, I think, is Mr. Chopra talked about the taking back of the losses. I would say even the issue of carry forward of losses will be a big issue, because there is an 8 years period, and due to this COVID crisis, in cases where this is the last or the 8th year of carry forward of losses, in the absence of the sufficient profits, one may forfeit those losses. And therefore, I think, again, as a matter of relaxation, what is important ultimately is this year of COVID 2019 should be excluded for all, wherever the thresholds are provided under the Act. So whether it be section 24, whether it be for carry forward of losses, and that I think will take care of most of the issues. I think due to time constraint with this, I come to the end of my presentation. I thank you so much for giving me this opportunity.
Thank you so much, Rohitji. I thank you a lot. And your suggestions on section 56 on taxability of income from other sources, on sale of property, and aspects of taxability of rent and salary, extremely welcome. Carry forward of losses for which period in current scenario of losses, extremely relevant. And I think the government needs to do something on that. With that, we are back. We are now on to the star speaker, as we've been calling him, Mr. Nicholas Jacob, the partner of Foster's LLP UK. Mr. Nicholas has been classified in who as one of the top 10 private client practitioners in the world. He advises on sophisticated private wealth planning, putting together plans that provide for family succession, the protection of the family businesses, the avoidance of family disputes, and all aspects of international family governance. He lectures throughout the world on private wealth issues. He has an extensive knowledge of taxation all over the world. So I welcome
Can you all hear me? Good afternoon. Can you hear me all right?
Yeah, you're very audible. Thank you.
Yes, sir.
Good afternoon. And I'm very honored to be joining you today, and thank you for your kind invitation. I've much enjoyed the presentations so far, and I hope I can respond to some of the issues that you've raised, which are covered from a UK perspective. So what I'm going to cover, I don't know if my slides can be shown. Unfortunately, I can't transition my slides, but I think there was arrangements made for everybody to see the slides. Anyway,
are you working on that?
Yes, sir. I'm working on that. Yes, sir. Just give me a moment.
While we're getting those up, what I'm going to cover are these areas. The economic stimulus measures that have been put in place from UK perspective, the statutory residence test, which will be interesting as a comparison to your own residence tests, central management and control, and permanent establishments, again, relevant to your situation as well. If you can play that. Then tax administration, deferring deadlines, tax tribunals, other matters which have been dealt with, and some speculation as to the result of COVID-19 from a tax point of view. And then on the next slide, I'm going to talk about economic stimulus measures. This is necessarily a summary of all the aspects that have taken place. There are some more details, but there isn't time to go into everything. But the main measures that were put in place quite early on, back in March, just around the time that lockdown was actually happening. Firstly, the bank-based interest rate was cut to 0.25% initially, and then a few days later down to 0.1%, obviously reducing the cost of borrowing and increasing cash flows for businesses. There was also salary and wage support for all UK employers who employed employees, and that was covering 80% of the employee's salary up to a maximum level of £2,500 per month, provided the employee was furloughed. I don't know if you have that terminology in India, but it's not very well known in the UK. Furloughed means that they are not made redundant, they're still employed, but they are off work, not allowed to work for a period, generally 3 weeks at a time, but they're kept on the payroll. So in order not to have to pay employees to be made redundant, they were being paid £2,500 per month. And the government was covering that up to 80%. A massive tax bill, but that still goes on. It's likely to terminate probably towards the end of June, I would expect. There was also support for self-employed workers in a similar way. If they are self-employed but unable to work because they can't go into the workplace or there's no work for them to do, again at 80% of their average monthly profits over the previous few months, up to £2,500, but that only kicks in from mid-June. So self-employed people are not as well treated as employees as it stands at the moment. There was also bank loan support, financial support for small and medium-sized businesses by virtue of bank loans, where the government was going to pay the interest for the first 12 months and any fees. Now, obviously, with very low interest rates, that's not going to be a big cost, but at least the interest was guaranteed by the government. There still is the obligation to repay the loan ultimately, but the banks have been encouraged to be lenient on repayments. Some banks have been more helpful than others in that respect. Then there is the large business interruption loan scheme, where there's a turnover of more than £45 million, up to £25 million of finance is provided by way of loan. And where the turnover of the business is more than 250 million, then the government will provide finance of up to 50 million of finance with an 80% guarantee. So that's a bank loan, but guaranteed by the bank, so guaranteed by the government, in order to ensure that facilities are made available where businesses were really suffering. There were also grants to help particular businesses, particularly those in the retail, hospitality and leisure businesses, and they're allowed to receive up to £25,000 per business property from which they operate. All businesses have to pay business rates, which is a tax on the property in which they operate from, and there is a holiday for many businesses, so they don't have to pay rates for a particular point in time. So there's been very significant economic support for businesses. It's not known how the government is going to be able to fund all this, but they're going to have to borrow very significantly, there's no doubt. And it's not clear what the total bill will be. Some people say that those measures don't go far enough. Others say they go far enough. Unfortunately, it will not stop a number of employees being made redundant when the furloughing procedure actually ends, probably in June. But hopefully it will have kept a lot of employees employed, at least during a very bad period. And when lockdown terminates, hopefully they will have a job to go back to, but clearly a number of them will not. Moving on to the next slide, the statutory residence test. Now, you referred to this, some of the previous speakers have referred to this in terms of people being stuck in the country and thereby being tax residents. And you have a very generous provision, I think, in India, which is more generous than in ours. Our basic rule is that for tax residence is based on the number of midnights spent in the UK and the number of connections. So the more connections one has, such as accommodation, business, and family, the fewer days one needs to spend in the UK in order to be tax resident. And clearly, every country has the problem that you've alluded to in India, and we have the problem that some people are caught unable to leave and may therefore become tax resident in the current UK tax year. As many of you will know, our tax year runs from the 6th of April to the following 5th April. So some people will have spent more days in the previous tax year, but not too many. Most of the additional days will be spent in the current tax year, which started in April. There are for exceptional circumstances, someone can, I'm hearing some feedback.
Carry on, you please carry on, I'm just getting rectified.
For exceptional circumstances, people can outstay the statutory period for up to 60 days. And that is generally for if somebody falls ill while they're in the UK, then if they cannot leave physically, they're allowed up to a further 60 days by concession. That's not regarded as relevant if one cannot leave because of a pandemic. However, the rules have been extended. So if people cannot travel to their intended country or are ill with the virus or are quarantined, then they are permitted a further 60 days, 60. Now, that's not that generous if lockdown happens for more than that period. If it does, it's likely to be extended, but at the moment, we can only be sure that the people have 60 days. So there may well be people who will be tax resident in the UK without intending to, and that could cause very significant problems. There may be further concessions proposed, but not at the moment, where people who need more than 60 days. If there is a risk there, we're advising people to try to avoid creating an additional tie. One of the ties is if they do business for up to 40 days, for over 40 days in the tax year, then that is a further tie, reducing the number of days they're allowed to spend in the UK without being tax resident. Or alternatively, if they have accommodation available for their use, ideally they would stay not in accommodation that's available, although of course most hotels will not be working at the moment, so it's very difficult for them to find alternative accommodation. It is very important, whatever one does, particularly if one is looking at exceeding the number of days, very important that full records are kept as to attempts to leave the country, what countries do not allow people coming in or would have to be quarantined for 14 days, what flights are running, what flights are not running, all the contemporaneous evidence that will be necessary for one to prove that one could not leave. Bearing in mind that we think the Revenue Authority, HMRC, at the moment they're feeling quite generous. We think that once things are back to a more normal scenario, they will be far less generous, and therefore the importance of keeping records now cannot be overemphasized. Moving on to the central management and control of overseas companies and permanent establishments, we have a similar rule to the rule that you have. If a non-UK company is controlled and managed in the UK, it will be regarded as UK tax resident and subject to UK corporation tax, which actually is at its lowest rate ever, at 19% at the moment. So it's not necessarily a complete disaster, but if it's in a nil tax regime, then that could be still very expensive. So if the company is controlled and managed in the UK by people who've had to stay in the UK, we have a much greater danger. In addition, if the company has an effectively stable and ongoing presence in the UK, it might create a permanent establishment, a concept I think you have in India as well. Excuse me. Either way, the company will be taxed in the UK if it is controlled and managed or creates a permanent establishment. Now, this is an area where there are more tax investigations than any other, and so people need to be careful about that. There are no specific COVID-related provisions in relation to this issue, and therefore it is quite a problem if people have to make decisions while they're in the UK because they cannot leave and decisions have to be made. Ideally, they would not make fundamental decisions. They would not manage the company from the UK other than possibly on a day-to-day basis. But ideally, the day-to-day work could be done by overseas directors. And ideally, if it's possible, directors overseas should be making all the significant decisions, or ideally significant decisions deferred if that is possible. That, of course, may not be possible, particularly in a COVID environment. And so, again, if one is forced to keep to be in the UK and forced to take decisions, one should keep detailed records of the fact that the person would have tried to leave the country but could not do so at the time when important decisions have to be taken. Full minutes should be kept in case there are subsequent concessions which are announced. But at the moment, there are no concessions announced. That has not been linked with the additional 60 days that people are allowed to stay in the UK. So if they have an additional 60 days because of COVID, but have to take decisions in relation to overseas companies, those decisions may well mean the company will be UK tax resident. We think that there will be some concessionary relief, but we don't know that at the moment. Moving on to tax administration and deferring deadlines. Again, I've heard what you're looking for in India. We've got some very specific provisions. The VAT, which is like a GST tax payments of 20%, which are due quarterly, those payments have been deferred by a 3-month period. So the March payments due in June, or longer if required. If companies simply cannot pay, they're likely to get more concessionary relief. But again, they need to keep records as to their cash flow, reasons why they're not able to pay, in order to make sure that contemporaneous evidence is available. Income tax payments for mainly the self-employed. Employed people are under PAYE, pay as you earn, have tax deducted by their employers. But for the self-employed and those who are landlords, they have to pay tax normally at the end of July and at the end of January in equal installments. The 31st July payment is deferred to 31st January 2021, which is a significant deferral, but of course it will mean quite a large payment due in 2021. And so people have to be wary of that as well. If organizations need time to pay, there's no specific deferral, but there will be tailored arrangements made with each business, and they will be on a more lenient basis than has been the case in normal times. If there is a delay in paying tax otherwise or submitting a return, then COVID-19 is regarded as a reasonable excuse for delay, and penalties are less likely to be imposed. Normally, there are quite strict penalties for delays in paying tax and submitting a return. However, interest is still likely to be payable. For those who need to have a tax assessment reviewed or appealed, there is more time to do that. And for those who are already engaged in tax investigations, they're being given more time to answer. And in fact, the HMRC are offering deferrals, although for a number of inquiries that we're involved with, we're actually not accepting those deferrals because it just delays the pain that taxpayers are going through. And we're putting HMRC to the sword to try and make a decision quicker by getting on with it rather than seeking to have a deferral. Where it's not possible to get all the records, for example, they're locked up in a safe in the office and one can't get to the office, people are being permitted generally to put in estimated returns, and they are the revenue are being urged, although there are no formal measures, to accelerate tax refunds so people have more cash with which to keep their businesses alive. For sick pay, which has to be paid for employees, there is support for businesses who are being supported by the government to pay sick pay or to cover sick pay that has to be paid for those who have got the virus. And then there are mortgage holidays of up to 3 months, which is just a deferral. The interest still has to be paid, but on a deferred basis. Now, it may well be that if lockdown goes on for longer, it'll be for longer than 3 months, but at the moment, that's the period during which banks and building societies are deferring their obligations. Tax tribunals, on the next slide. These are where appeals are made. In March, all proceedings were delayed, deferred until 30th of June, so basically 3-month deferral, and time limits for all procedural requirements for appeals are extended by 70 days. So if people have missed deadlines, that generally doesn't matter, except that obviously the whole process is deferred. There are currently no physical hearings for obvious reasons, and all hearings are by email, paper, video. There are some telephone hearings, quite a few video hearings, but where that's not suitable, then there will be an indefinite deferral of the hearing. particularly if there are a large number of witnesses who are required or people are ill. Time limits, however, for lodging an appeal still apply, but if they are late for good reason, for example, the appellant has got the virus, then generally speaking, provided there is contemporaneous evidence provided, concessionary relief can be applied for. And all judges are working remotely, mainly by video, but they're doing interlocutory hearings generally by paper or email, if the application lends itself to be done on that basis. Other matters which are relevant, I mentioned nudge letters. Now, what's happened following the implementation of the Common Reporting Standard, automatic exchange of information, all revenue authorities of all countries where the country is a member is receiving much more information about offshore income and gains. And in the UK, if the offshore income and gains have not been reported, then so-called nudge letters are being sent by HMRC to taxpayers to say, why haven't you reported this? There may well be a good reason. In the UK, particularly if they're not domiciled, they may well be able to avoid tax on their offshore income and gains if not remitted into the UK. And there may be other reasons why tax has not been paid. So those letters generally have a deadline of 30 days. That 30 days is not deferred, but if the person is ill or unable to get the information, then they can make a request that the response time be deferred. We have, at any one time, we have a number of tax consultations going on, and there are about 8 or 9 going on at the moment. These are where consultations are given to taxpayers to respond to specific proposed provisions. I'm not going to go through all of those, but there is one consultation for stamp duty land tax, SDLT, to be increased for non-residents holding UK residential property by an additional 1%. That's out for consultation at the moment. There's a consultation on the HMRC Charter intended to deal fairly with taxpayers, and there's one on withdrawal of LIBOR, the tax implications of that, the London Interbank or operating rate. But there's no deferral on a consultation which has completed on the 5th Anti-Money Laundering Directive, which is a European directive, but will have effect globally for European countries, particularly registering trusts that are administered from their jurisdiction. We also in the UK have a provision that inheritance tax, generally tax on death, if somebody owns a very valuable artwork or a particular property which is of unique interest, then they can allow access to the public to those items, and that will relieve the tax that would otherwise have to be paid. Of course, at the moment with lockdown, these properties can't be visited by people and museums can't be showing artworks. There's a specific relief for that, and there'll be no breach of those terms. Normally, if there is a breach of those terms, then the tax immediately becomes payable, but here that won't be the case. Annual tax on enveloped dwellings, ATED. If any of you have dealt with UK residential property owned by an offshore company or any kind of company, there's an additional tax payable where a company owns a UK residential property. That is being deferred where distinctive property is owned by a company. It has a relief from the ATED payment. If that property can't be visited, that relief will still apply for the duration of the COVID-19 pandemic. National Health Service, we have, as you probably know, a well-known free medical treatment for anybody based in the UK. A lot of the people who've worked there for the NHS have sadly passed away as a result of being exposure to patients with the virus. And there's a relief that none of those will have to pay inheritance tax, death tax, if one, they work for the NHS, and two, it's proven that they obtained the virus from their work within the NHS. And then finally, there's a campaign, nothing yet specific solidly yet, to prevent residents of low tax centres benefiting from taxpayers' money. So, for example, Virgin Atlantic has asked for £500 million grant from, sorry, not £500 million, £500 million, I'm sorry, £500 million, has asked for a grant to keep the airline afloat. But Richard Branson is domiciled in the British Virgin Islands, and a lot of people are up in arms that he should be able to claim taxpayers' money for his airline when he's living in a tax haven. Now, there are rights and wrongs about that, which we won't go into now, but it's something which is some people are having a real concern about. And then finally, speculation as to what will happen in the future. As I indicated, and as will be the case in every country, the cost to the government of all these measures will be absolutely enormous. And it's uncertain how much that will be, and of course it is ongoing. So we think that there will be some tax increases. All of this is pure speculation at the moment. Some people suggest there will be a wealth tax introduced quite quickly. I think that's a lot more difficult to introduce quickly. We may have a budget in November, at which it could be introduced, but I think that's unlikely, or could be a one-off tax. But I think that we need to have a greater assessment as to the impact of that before it's introduced. Inheritance tax, which is tax on death, as I said, is taxed at 40% above £325,000 per person. There are some changes proposed that may well be accelerated, that will tax lifetime gifts. Only at the moment, lifetime gifts into trust are taxed at 20%, but otherwise lifetime gifts are not taxable. And there's a very valuable relief called business property relief for trading businesses, which means that if somebody passes away owning shares in a private trading company, they won't pay inheritance tax on those shares, because generally those trading companies are not easily realizable. We may well find there are some accelerated changes to inheritance tax as well. At the moment, we have a top rate of income tax of 45% above £150,000. It could be that rate increases in order to cover some of the cost. Capital gains tax is generally taxed at 20% at the moment on capital gains. No capital gains tax on death. That rate could be increased as well. We might well see a withdrawal or restriction of certain tax reliefs, but again, that's speculative at the moment. Those reliefs are being examined by a commission at the moment, and that could be accelerated. We have had a significant focus on anti-avoidance and anti-evasion, and that could well be increased, although the common reporting standard has prevented a lot of that happening. And so, we might see some stricter rules on that. And there is a lot of concern about people abusing COVID reliefs and claiming payments from the government where it's not appropriate or not actually legitimate. That's always the danger of introducing things very quickly, which the government did. And the government is to be praised for doing that, because it certainly has kept a number of businesses alive that would not otherwise have been kept alive. So I hope that gives you an idea as to what's happened in the UK. I would be very happy to answer any questions if there are any, but I hope that gives you an overview. There's a lot more detail I could have gone into, but of course, time is always against us. So again, thank you for the honor of allowing me to present at your webinar.
Thank you so much, Mr. Nicholas Jacob. Your presentation was extremely extensive, extremely relevant, gave a clear insight of what exactly UK has done in these extreme circumstances. A lot of reliefs that UK has given, which India we hope may give. But of course, the strength of the economy, of both the economies are so varying. So I don't know whether India can actually make payment of wages as UK has done, or make payment of interest. But I thank you a lot for sparing your time today, for being with us. We look forward to having you again sometime on probably a similar or a different topic. and we thank you a lot. Thank you. With this, I hand over to our Vice President, Mr. Pradeep Multani, who has spared a lot of time with us today. We thank you so much, sir, for your gracious presence, and it's over to you now for the vote of thanks.
Sir, before the vote of thanks, can we take a few questions from the audience? Please unmute, sir. Please unmute.
We have a couple of questions on the chat, but one is, can we request government for GST/tax payment on receipt basis at least till 31st March 21 to minimize the burden on the companies? I think we can discuss among the committee and see if we can forward that, but it's a very vast area, and we need to discuss it among ourselves, the Direct Tax Committee, and we can take a call on that. The second question is, why can't the government of India consider refund of a portion of tax paid by the salaried class assessee in these hourly prices, like done by government of Singapore and USA? So as we've already discussed, would I request Mr. Anil Chopra to give his views on that? Anilji, can you just unmute yourself, please?
Well, I think we've noted the point, and here again, let us discuss it internally. But I don't know if refunds per se are going to be possible. There are big constraints on funds with the government. But yes, on some rational or some basis, matter-to-matter basis, under various provisions, certain things may be better to ask now in the current year when the effect of COVID is more so, because it was actually only there for a few days last year.
Correct. Okay, over to Pradeep sir, Multani ji, for your vote of thanks, please.
Thank you, Mukul-ji. Can you hear me?
Yes, sir. Go ahead.
Yeah, thank you very much. Yeah. Mr. Nicholas Jacob, partner Forsters LLP UK, Dr. D.K. Agarwal, our president of PhD, Mr. Anil Kumar Chopra, mentor, Mr. Mukul Bagla, chairman, Mr. Rohit Jain, partner, Vesh Associates, Dr. S.P. Sharma, chief economist, PhD chamber, managing committee members, eminent dignitaries, ladies and gentlemen. A very good evening to all of you. It is my pleasure to propose the formal vote of thanks to the esteemed speakers, participants in the webinar on COVID-19 impact on direct tax liability. I would like to sincerely express my gratitude to our eminent speakers who have spared their valuable time for this webinar. We are very thankful to you for sharing your valuable insight on the subject. We are extremely thankful to Mr. Nicholas Jacob, partner, Forsters LLP UK, for joining us today and sharing his valuable inputs with us. In light of the ongoing COVID-19 crisis, the government has announced a slew of tax and regulatory relief measures to provide a compliance breather to individuals and businesses. I hope today's webinar have shed light on the issues faced by the industry stakeholders amid pandemic COVID-19 and suggestive measures to mitigate the impact of pandemic COVID-19 on trade and industry. With these words, I once again thank all the esteemed speakers and participants for joining us today. Thank you very much. Jai Hind, and God bless United Kingdom, India, and all our people to get out of this China virus very fast. Thank you very much.
Thanks a lot, Pradeep ji. I would again thank all the speakers, Anil ji, Mr. Nicholas, Mr. Rohit. I thank the entire team of the Secretariat, Saurabh Sanyal ji, Dr. Sharma, Surbhi, Shikha, and Taranjeet, and the other team members. Thank you so much for your cooperation. I thank all the delegates, and we shall be back with some other topic very soon. Thank you so much.